And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And I'll tell you what, there's a bunch of information out there on the internet that's trying to let you believe that they're working on your financial freedom, but I don't believe it. I think there's a bunch of garbage out there on the internet. Now, there is some really good information that you can cull from the internet. There really is. There's some great content out there. I don't mean to pick on content on the internet and say that it's all bad, because some of that content out there is really some really good stuff, especially the stuff that we publish at Lifestyles Unlimited. I would tell you that is very, very good content because it's designed to help you. It's designed to help you retire in the next 5 years instead of the next 30, 40, or 50 years. Yeah, but there's also some bad information out there. Now, some of the bad information, it exists just because it's bad information. Whoever published it didn't really know what they were doing. They just wanted to get something in the internet, and they got it in the internet or on the internet or however you do that. And they published, and they're on the internet. Yeah, whoopee. And all the information is garbage. It's garbage. Now, other people will post information that seems to be relative information. They'll give you enough information to help convince you that you need to do what they want you to do. Yeah, you know what I'm talking about. Yeah, it's called suggestive selling. It's called advertising. It's called let's put some stuff on the internet and let's get people thinking about stuff. So why am I bagging on the internet? Well, I'm not 100% bagging on the internet, but I am bagging on the internet. I'm really bagging on some of the content that's on the internet, and this is what got me all riled up today. I'm reading an article on the Investopedia website. Now, Investopedia is and let's just call them who they are. They are focused on helping you invest your money through the stock market. Okay. And it's out there. You can check them out. I don't think they're a bad organization at all. I'm not even going to make any opinions about Investopedia, but I am going to make an opinion about one of the articles that I found on their website. And this is the article that caught my eye. It starts off by saying how to double your money. How to double your money. So if you are an investor, one of the key concepts that you need to wrap your head around is this doubling effect, this concept of doubling your money in whatever you're investing. Now, I'm here to tell you, you can invest in just about anything and you could eventually double your money. Yeah, I'm 100% serious about that. You could invest in just about anything and you could eventually double your money. You could also lose all your money, but you could eventually double your money. The key thing that we don't know is the timeline. How long is it going to take you to double your money? Now, this article, How to Double Your Money, that's posted on Investopedia's website, the first thing that comes to my mind is when I read an article that's trying to give me information about, things like investing, I want to know who's writing the article. I want to know what possible spin they're bringing to the equation. So the article's written by a gentleman by the name of Ken Clark. I don't know Ken Clark, but here's what I do know about Ken Clark. He has co-managed over $100 million in retirement accounts and is the author of The Complete Idiot's Guide to Getting Out of Debt. Okay, so this is what I know so far about Ken Clark. He has spent a lot of time in the financial services industry. So he wrote this article based on his experiences. He's going to give you his experiences on how you should double your money. And he actually writes about 5 different ways that you can double your money. We'll get into those in a minute. Now, the article was reviewed by somebody by the name of Samantha Silberstein. Now, Samantha is a certified financial planner. She holds the Series 7 and Series 63 FINRA licenses. So Samantha, she is heavily invested in the stock market side of investing. So again, she reviewed this article and she obviously agrees with Ken, and both of them have experience in the financial services industry. Now, this is the part that I thought was really interesting. This article was fact-checked. It was fact-checked. Now, it was fact-checked by a lady by the name of Katrina Avila Muccioliello. I hope I didn't butcher your name, Katrina. If I did, I apologize. She is an experienced editor, writer, fact-checker, and proofreader with more than 14 years of experience working with print and online publications. But here's the thing. This fact-checker doesn't list any financial services experience, nor does she list any real estate investing experience as part of her background. So I'm not quite sure what she's fact-checking. She's fact-checking the fact that there's information being provided. It is skewed to one lane, and it doesn't do a great job of exploring all the possible options that are out there on how you can double your money. Okay? Are we clear on this? Now, the reason I'm bringing this up is one of the strategies you can pursue as a Lifestyles Unlimited member is to look for assets that will give you the opportunity to double your money. It has to do with real estate investing, and it has to do with something called equity capture. You heard me correctly, equity capture. But before I get too deep into the weeds about equity capture and how it can double your money instantaneously, I'm going to get back into Ken's article because he identifies what he considers 5 ways to double your assets through investment. And all of these ways have nothing to do with real estate. As a matter of fact, later on in the article, he kind of poo-poos on real estate. And I'll talk about that in a moment. But let me talk about the 5 different ways that he's talking about. He's talking about the classic way. In other words, what you're probably doing in your particular investment account, whatever you have. Maybe you've got a 401k or an IRA. Maybe you do your own stock investing, whatever. He's talking about something that he calls the classic way. And the classic way is a mixture. It is a mixture. What they do is they advise you to spend about 60% of your portfolio in what they call equities, and then they call those equities blue chip stocks, right? So it makes it sound like they're really great investments because they're blue chip stocks. Well, you know what blue chip stocks really refers to? Companies have been around for a long time. They're no longer in a growth phase. Maybe they're paying a dividend, which could be okay. That would pay you some money every month in the form of cash flow. But if you're investing in those retirement accounts, all the money has to go back to those retirement accounts. You can't use it to retire yourself. So there, I said it. The other 40% would come from what they call investment grade bonds. Investment grade bonds. So I guess there are bonds out there that are not considered investment grade. Okay, let's get to the doubling effect. He said the classic 60-40 portfolio returns about 8.7% annually during the time period of 1928 through 2020. Yeah, so that's a big range of years. It's almost 100 years. So an 8.7% annual return. Okay, then he jumps into something that he calls the rule of 72, which means based on the rule of 72, if you're getting an 8.7% annual return, you should be able to double your portfolio value, you ready for it, in 8.3 years. 8.3 years. Then he goes on to say, you'll quadruple in 16.5 years. Okay. So quadrupling is just a doubling of the doubling, and it's going to take you another basically 8.3 years. So that type of investment can double your money, and it can get done about every 8.3 years. That's too slow for me. It is too slow. Now, he talks about another way to make money. He talks about something called the contrarian way, which is basically doing the opposite of what the herd mentality is doing. That's kind of what we do at Lifestyles Unlimited. We're kind of doing the opposite of what the herd mentality is doing because we're not investing our money in the stock market. Too risky, too much like gambling, not interested in it, like a good asset that if I wanted to go and touch it, I could go touch it, as opposed to these paper assets that you're probably investing in. Yeah, I know. You think you're invested in companies, and you are invested in companies, but you're invested in micro shares of a mutual fund that actually owns the companies. Yeah, that's kind of the way it all works out. All right, here's another doubling effect. Now, he cites this right in the middle of the article after he gets through talking about how you can get an 8.3-year doubling effect by doing that 60-40 thing. What he's talking about is if you invested in the S&P 500 and from the period of 2019 to 2021, the S&P 500 returned a 100% return in a 3-year period, despite the fact that in the middle of that period, somewhere around the period of February to March of 2020, it plunged 35% while it was trying to do this doubling effect. So, I mean, if you could handle the swings of the stock market, you could handle the fact that you thought you were making money and then all of a sudden you weren't making money and then all of a sudden you were making money again. If you could handle that kind of roller coaster, then he's saying you could double your money every 3 years. Every 3 years. That's better than 8.3, but it's not good enough. Now, here's the part where he talks about real estate. Yeah, I've got to talk about this part because you have to understand he's writing what he's writing from the lens of somebody that is deeply immersed in the financial services industry. He's speaking from what he knows. And I'm not talking bad about him. I'm just telling you he speaks from the place where he comes from, if you will. Okay, does that make sense? Okay, so he's got a section in here that says, what about real estate? And then he says real estate's another traditional way to build wealth, although, now get this, it is a far less attractive position at times like the present. Oh, what's he getting at? What's he getting at? All right, let's check it out. When housing prices in North America have surged to record levels in many regions, the prospect of rising interest rates also reduces the appeal of real estate investment. No, it doesn't. Do you understand that real estate has achieved record high prices practically every year that we've been in existence as a country? Are you aware of that? Are you aware that back in, say, I don't know, the 1700s, you could buy real estate for a fraction of what it would cost today, and that real estate had gone up in value over time? See, he's not articulating that, is he? No, he's not. Now, here's the other thing. He doesn't understand real estate, so he cannot articulate it the way I can articulate it to you because I fully understand this real estate investing modality. I understand the different strategies that we can use to make money in real estate. I understand that we can use equity capture to double our position in our investment asset instantaneously. Yeah, and I'm going to get into those a little bit later on in the show. I got to get back to what he's saying here because it's just like fingers on a chalkboard to me. That's what it feels like. So he says, that said, during a real estate boom, the prospect of doubling one's money proves irresistible to many investors because the huge amount of leverage. Yeah, that's right. We use leverage provided from mortgage financing can really juice up returns. Well, maybe you have been paying attention. For example, a 20% down payment on an investment property worth $500,000 would require an investor to plunk down $100,000, get a mortgage for the balance of the $400,000. If the property appreciates 20% to $600,000 in the next few years, the investor now has the equity worth $200,000 in it, which represents a doubling of the original $100,000 investment. And here's the problem. He is only citing one of the 5 ways we make money in real estate. He is only looking at something called natural appreciation. Now, we as real estate investors, we get natural appreciation on all of our assets. Our assets are going up in value. It's just the way it is. Some assets right now in the current marketplace, some assets are coming down in value, but it depends on the type of asset. It depends on where it's located, and there's a lot of other things that go into it. But ultimately, real estate, now get this, real estate will double in value just based on natural appreciation every 20 years. When we come back from the break, more on doubling your money.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next. creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I'm working on your financial freedom. And on today's show, I've been kind of rough on a guy by the name of Ken who wrote an article for Investopedia where he's talking about the different ways you can double your money. He's actually come up with 5 different ways you can double your money. And here's what I'm finding from all the different ways that he is suggesting. To be honest with you, I have not given you all 5 ways that he suggested, because not all 5 ways actually come with a metric for how soon you're going to double your money. So there's a lot of hurry up and wait involved with the methodologies. Now, his the fifth way, he calls the best way. Now get this. I'm not making this up. This is exactly the way I'm reading this. I'm reading it that the best way to double your money is in what he's saying is to have a matching contribution in a 401k. What he's saying is for every dollar that you put in, if your employer matches your dollar, you just doubled your money. That's what he's implying in this particular article. I don't consider that doubling of your money. I consider that money that is part of your salary and compensation package. And as such, that would be included in whatever money you're putting in. And then he doesn't really talk about how long is it really going to take for that money, even when it's matched, to double. And if I go back to the first recommendation that he made when he was talking about the 60-40 way, the classic way, he was recommending that it would take 8.3 years. So I don't know. The S&P recommendation that he made was 3 years. But these are all, it's taking too long to double my money. I know for a fact that if I buy the right asset in the right location, I can double my money instantaneously. You want to know how to do it? All right. This is how you do it. You do it through something called equity capture. You heard me correctly, equity capture. So what is this equity capture that I'm talking about? Well, equity capture it's a very simple concept. It really is. Here, I'll just give you the Lifestyles Unlimited definition. It's a very rudimentary definition, but it'll make total sense to you. So equity capture is when you buy an asset for less money than it's worth. You heard me correctly. You're essentially buying the asset at wholesale pricing, and then you're commanding the asset or you're owning the property at retail pricing. So in real estate, the easiest way to explain it is, let's say you buy a house in a neighborhood where all the houses, when they're fixed up, they're worth $100,000. Now, you can find an asset in that $100,000 neighborhood that you can pay $50,000 for because it's got problems, it's got issues. There are things that are wrong with this property, and as such, it's making it very difficult for the owner of the property to transact the property, because most people that are in the buying market that are not real estate investors want something that's already fixed up, already in good shape, with the appliances, less than 2 years old. And when you start looking at distressed properties, none of that applies to a distressed property. A distressed property is usually one that's been worn out. It's been consumed over time, and nobody's put any money back into the property to breathe life back into it. That's where we as real estate investors, that's where we come in. So we can buy this asset for $50,000 because it's got issues. It's going to take some time. It's going to take some treasure to get this thing fixed up. And we know that if we drop about $20,000 into this property, we can breathe new life into the property. So all in, between the acquisition and the repair costs, we're all in at $70,000. But the asset is worth $100,000. What we've just done is we have captured $30,000 in equity. $30,000 in equity. And if it costs us less than $30,000 cash out of pocket to buy this particular asset, and in which case the numbers would suggest that yes, it would cost us less than $30,000 cash out of pocket to buy this asset, we have more than doubled our equity in the asset. It's an unrealized capital gain, meaning the value is there, but you haven't tapped into the value. There's 2 ways you could tap into the value. One way is you do a refinance. You refinance the property and you take the money out that way. That, by the way, is a tax-free event. Because what you're doing is you're restructuring debt on the property. You're not doing anything else. So the IRS doesn't care. The IRS only cares when you transact the property, which is, by the way, is the second way for you to tap into the equity. You sell the property to somebody else that wants that asset. Maybe it's somebody that wants to own it, to live in it and consume it themselves. Or maybe you sell it to another investor that's going to put it back into the marketplace as clean, functional workforce housing. It doesn't matter who your buyer is. The fact is they bought your asset. That's what's important, because you're going to harvest that unrealized capital gains when you do either of those two events, either the tax-free cash out refinance or the taxable event of selling the property, but you're only subject to long-term capital gains rates because you have held that property for a year and a day. Very important you get that in your head. You must hold the property for a year and a day. If you don't, then you're subject to something called short-term capital gains rates, which are much more oppressive from a taxation standpoint than the long-term capital gains. Let me just share with you what I'm seeing, and you'll recognize what I have found. So this particular property came to me from Devane. He is in the Kansas City market, and this particular property is going to require about $36,000 cash out of pocket, but will capture $46,000 of equity in this particular asset. So even though it's going to take $36,000 for me to buy into this deal, I'm going to have something like, I don't know, the math isn't even working in my head, $82,000 in total equity. That is more than a doubling effect of my money. This next one, this one's pretty neat too, because this particular deal came to me. It's from Michael. This particular property is in the San Antonio market. It would take me a little over $28,000 to do this particular deal. Now get this. This particular asset is going to produce almost $45,000 in equity capture. So now we're beyond a doubling effect of our money. We're actually talking about getting closer to a tripling effect of our money. And this particular asset can do that for us. But you know what? There's still two more that we need to talk about. And I tell you, these are some pretty neat properties. So this one here, it came from Moon. This is in Houston. Now, what I liked about this particular property was it's going to take about $16,000 cash out of pocket for me to do this deal. So one of the things I like about this particular deal is that my cash out of pocket is a lot lower than some of those other deals that I mentioned. Now, this particular deal is only about $16,000 cash out of pocket. Okay, so this particular property can produce over $28,000 in equity capture. So I'm buying in for $16,000, and I'm almost tripling my equity in this particular property. There's another property that does better than that one. And this one came to me from Sam. It's up in the Dallas-Fort Worth area. Have you noticed that I'm talking about all kinds of different real estate markets? Did you pick up on that? I'm focused on what that market can provide to me. This is what's important to me. And this particular deal that came from Sam, this is the best of the 12, in Al's opinion, based on Al's parameters. I'm seeing almost $19,000 cash out of pocket. So it's a little bit more money out of pocket than the property that Moon gave me, which was about $16,000. So, okay, a little bit more cash out of pocket. It's going to return almost $35,000 in equity capture. This one is almost a tripling effect. What do? What I do is I buy it. I renovate it. I find a great resident to live there at market rent rates. Oh, by the way, another reason that I like this property that Sam sent me over the one that Moon sent me had to do with the cash flow. I mean, either property is going to produce almost a tripling effect of my money. That's better than double. But the cash flow from the deal that Sam sent me produces about $432 a month in cash flow after all the expenses are dealt with, versus the property that Moon sent me only produces about $240 a month in cash flow. Now, I would buy this property, and my initial game plan would be to hold the property for 5 years. So I fix everything up, and I hold it for upwards of 5 years. That's my strategy. Let's say I own the property for a year. I know for a fact when I bought into this property, I almost tripled my equity in the asset. So what if I sold the property at the end of year one? It depends on whether you want that cash flow. That $432 a month that this property is producing is nothing to sneeze at. That's good cash flow. That's cash flow you're going to use to retire yourself. But man, all that equity in that property, all that equity that's sitting there. Now, think about it. You put a little over $18,000 into this property, and you're getting almost $35,000 in equity, right? So there's well over $50,000 in equity sitting in this property. It might make sense for us to sell the property at the end of year one and a day. Remember, and a day, because we don't want short-term capital gains taxes. We want long-term capital gains taxes. So we sell at the end of a year and a day. We have effectively, after the expenses of selling, we have more than doubled our money in a year. Some of you are saying, but Al, you said you doubled your money instantaneously. You just said you had to wait a whole year to get your money. You're right. I did say that because I identified the unrealized capital gains that you have in this property right up front. And here's the other thing. When I sell that property, I can turn around and I could buy 2 properties to replace it. So not only am I doubling my money when I bought that very first property, this property we're talking about that came from Sam, if I held it for a year and I sold it, I would have enough money available to me that I could buy 2 more properties. So at the end of 1 year, not only have I more than doubled my money, I've also doubled my asset count. You heard me correctly. I've doubled my asset count. Now, this kind of investing is not difficult to do. It is not difficult to do, but it does require that you have an education, that you understand how to invest correctly in real estate, that you understand all of the components of investing, all of the financial analysis, all of the rehab stuff, all of the salesmanship aspects. Yeah, there's a little bit of salesmanship involved, but here's the key thing. When you've built a team around you that does 99% of what you need to have done, that only leaves 1% in your lane as the responsible party. Yeah, you heard me correctly. There's only 1% that's actually in your lane that you really have to deal with because you have other people doing things for you. So let's take a step back and let's map out a map for you. You buy one property in year one. You spend upwards of $20,000 on it. You sell it at the end of year one and a day, and let's say you made $50,000 cleared on the property. Now you have $25,000 available that you can buy 2 assets with. Yeah, $25,000 per asset is where I was going. So now you buy 2 assets at the end or the beginning of year 2, right? And you do the same thing. $25,000 in, you're looking for a doubling effect of your money because at the beginning of year 3, you want to be able to sell those 2 assets that you bought, and you want to be able to buy 4 at the end of year 3. And let's say you do the same thing. And in year 4, you sell those 4 properties and you buy 8 properties at the beginning of year 4. Now let's talk about what you do at year 5. You sold all 5 of those properties, all 8, I've lost count. All 8 of those properties you've sold, and now you're going to buy 16 properties. All right, let's take a break right there, because if you have 16 properties producing $400 a month in passive income, you now have an income stream of $6,400. And by the way, that income is protected by the depreciation write-offs that come from those assets, and therefore you're probably not going to pay any income tax on that money that you take as cash flow because it is sheltered by the depreciation. So what does this all amount to? What I just explained to you is literally a 5-year plan that can get you to a place of retirement in the next 5 years, that can produce $6,400 a month in income for yourself and your family. And here's the neat thing. It started off with us investing only $20,000 of our own money. You heard me correctly. I just laid out a plan that if you follow it to the T, cost you $20,000 of your initial capital investment, yet you doubled your money over time and you retired yourself in 5 years or less. If you want to learn how to do this, go to lifestylesunlimited.com, get signed up for a free workshop, and let us show you how.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.